Okay, let's unpack the Allegro Group Q2 2025 earnings call. We're doing a deep dive here into the Polish e-commerce giant's performance. And it's a fascinating picture, really, bit of a paradox. The core numbers, they look, well, exceptionally strong, financially, strategically solid, yet you look at the market's immediate reaction, and it was decidedly chilly. The stock actually traded lower on the day.
Yeah, and that divergence is exactly what we need to synthesize for you. Our job here is to sort of weave together the management commentary, the hard financials, and, the overall market context to really explain why these pretty material beats, especially in profitability, just didn't translate into investor excitement.
It seems like the present success was kind of capped by worries about the future costs, maybe legal stuff.
Precisely. Perceived risk definitely overshadowed the current performance.
Okay, so let's start with the top line summary then. Just establish how robust this quarter actually was. We need those baseline numbers before we diagnose the skepticism.
Absolutely. Operationally, it was very strong. Revenue landed at PLN 2,972 million. That's a solid 10% growth year over year, and it did beat consensus, just slightly. But the real story, I think, was the margin expansion and, well, cost control.
Meaning profitability really outperformed what people were expecting.
Oh, absolutely. Adjusted EBITDA was the big headline here. It soared about 20% year over year, hitting PLN 791 million. And that figure was, comfortably ahead of what the market was looking for. Shows management's got a firm grip on costs, and they're improving that monetization mix.
And EPS.
Yeah, GAAP-diluted EPS also saw a nice year-over-year bump, came in at PLN 0.36 compared to PLN 0.33 last year.
Okay, so on the surface, it sounds like a company just firing on all cylinders. But if we drill into the segments a bit, you start to see maybe the first flicker of complexity. Poland delivered that stellar GMV growth, 9.8% year over year. But the international segment, that was softer, actually shrank by 7.7%.
That contrast definitely matters. But the key insight, really, is that the Polish core is the profit engine. So despite those clear operational wins, a strong beat on profit, accelerating growth at home investors basically chose to focus on the risks, margin uncertainty, rather than the results right in front of them. It was all about the future threat, not the present success.
Okay, let's focus on that engine then, the core Polish market execution. Because Allegro isn't just keeping pace with the Polish economy, they seem to be dominating it. That 9.8% GMV growth, they said it was more than twice the nominal growth seen in overall Polish retail sales. They're actively taking share.
Yeah, and that success isn't just about volume, it's driven by loyalty too.
Yeah.
The active buyer count, it grew to 15.2 million, which is good, but the real measure of stickiness, I think, is that the annual spend per buyer, that increased 8% year over year, now stands at PLN 4,178. That signals fantastic customer retention, and rising wallet share with their most valuable users.
And they're getting much better at monetizing that spend too, right? The Poland take rate jumped significantly, 13.01% in Q2. That's up almost half a percentage point year over year. What was the main reason they gave for that boost?
Management was pretty clear. It was mainly driven by their own strategic adjustments, specifically those co-financing rate changes they put in place back in March. So for you listening, this basically means Allegro is flexing its internal pricing power. They're raising the effective commissions and fees on sellers to boost their own bottom line. And this internal control, that's their key lever against those external cost pressures we mentioned. Critical point we'll come back to.
And it's not just the core marketplace fees. Their other businesses are helping too, right? That advertising business line, growing over 30% year over year. That's substantial.
Very substantial. And Allegro Pay, their buy now, pay later service, that's maturing rapidly too. Funded 15.3% of Polish GMV in the quarter? These aren't just small side projects, they're becoming high-margin growth engines.
Okay, so the core business is humming. But the really defining strategic shift this quarter feels like that aggressive push into logistics control. Management's betting big on owning the whole customer experience, not just the website.
Correct. And this logistics push, it's essentially their main defense mechanism against external threats, specifically those rising costs from third-party delivery partners.
Right. So let's talk about Allegro managed volumes. That's the metric for parcels they control the shipping for.
Exactly. And that increased by a pretty substantial 4.6 percentage points just quarter over quarter. It's now sitting at 34% of all their parcels.
And why is 34% so important?
Well, because this strategic shift is fundamentally changing their cost structure. It gives them leverage. It lets them better offset external cost hikes, like that double-digit price increase they had to absorb from their biggest delivery partner right at the start of the year.
Wait a second, though. They beat profitability expectations, But then they ramped up their capital expenditures, their CapEx, by a massive 72% year over year. Doesn't that sound like they're trying to plug a future leak? Isn't that CapEx spike a huge hit to margins right now, even if the long-term goal makes sense?
It is aggressive, yes. But management clearly views this as necessary, almost defensive CapEx. It's an investment to safeguard future margins. They're putting their money where their mouth is, committing to deploy over 8,000 of their own parcel lockers by year end. That's actually 1,000 more than they originally planned. And importantly, they're doing this within the existing capital budget, which shows some efficiency.
And they also strengthened the network with that new DPD partnership deal.
Correct. That partnership was a big boost for the Allegro delivery program. Brings the total parcel locker count in their network, theirs and partners, to over 33,000. The message is really clear. They're moving from being just a logistics consumer, kind of hostage to third-party pricing, to becoming a logistics controller, someone who can actually influence the pricing landscape.
Okay, let's pivot now. Let's talk broader strategy under the new CEO and maybe resolve that mixed international picture. Management's calling this period accelerated evolution. What does that mean?
Well, they seem to be broadening their definition of what Allegro actually is. They're actively talking up several new strategic growth areas. Things like expanding beyond the, 80 million product categories they already have, and exploring the services segment more, things like financial services, insurance.
And what really caught my eye, could be transformative for how people value the company, is this talk about potentially externalizing services.
Yes, that's a big one.
Selling things like Allegro Pay, their BNPL solution, or even their logistics infrastructure off their platform to other merchants, like following the Amazon Web Services playbook. That's a whole different business model.
It absolutely is. It's a signal they intend to unlock significant value from the infrastructure they've built. And yeah, it implies a potential re-rating of their valuation multiple if they can pull it off. Now, on the international side, the story was mixed, but kind of intentionally so. Allegro International GMV, if you just look at the new marketplaces, Czechia, Slovakia, Hungary, that actually grew a phenomenal 61%.
Okay, so why did the overall international GMV number look negative then, like we saw in the snapshot?
Because that really strong growth in the new markets was completely offset by them deliberately winding down the old unprofitable Mall North e-shop business. That legacy unit saw its GMV just plummet, down almost 59%. But crucially, management said that whole transformation is now complete. Mall North is rolled into Allegro International. The focus now is entirely on the capital-light third-party marketplace model and getting to profitability there. So we should expect that drag from international to decrease quite a bit going forward.
Right. Now we get to the crux of it. Why didn't the market love these great Q2 results? The full year 2025 guidance update.
This is exactly where the market skepticism really hardened. Okay, so group revenue guidance, that was slightly raised and narrowed to plus 8-11%. Good. But the adjusted EBITDA guidance, it was only narrowed, tightened to a range of plus 13-17% from the previous, plus 10-17%. And for Poland specifically, the guide remains pretty robust, no major changes there.
So the market really zeroed in on that group EBITDA range only being narrowed, not raised.
Exactly. The thinking was, if the company beat Q2 profit expectations so heavily, why didn't the full-year profit guidance move up more significantly? The fact it was just tightened suggested to investors that, well, these legal and cost overhangs must be pretty severe, limiting the perceived upside for the rest of the year.
And the biggest known risk, the sort of elephant in the room here, limiting how people value the stock, that's the InPost arbitration, right?
That's the big one.
This feels critical. Can you just lay out the situation there? Why does it feel like there's a sort of Damocles hanging over the stock?
Yeah, it's an ongoing, pretty high-stakes legal dispute. It's about the delivery contract they have with InPost, which runs until 2027. Management is basically pushing hard for lower prices through this arbitration process. But at the same time, they're trying to reduce their reliance on InPost by accelerating their own Allegro delivery program, building their own thing. So the market sees this legal uncertainty, the potential cost implications down the road, and treats it as a clear watch item. It's preventing a full valuation, basically. Allegro's defense is just building a better alternative themselves.
Okay, let's talk about that defense then, the financial foundation. Does their capital position look solid enough to handle this big CapEx push and potential legal costs?
It does, yeah. Their leverage is actually decreasing. It was down to 0.72x adjusted EBITDA before the buyback started. And even after they did that successful PLN 1 billion bond issue in July and the PLN 1.4 billion share buyback program, the pro forma leverage is still only around 1.16x. That's pretty manageable. Their long-term target is 1x leverage. So yeah, they seem to have the financial flexibility to execute this logistics transformation without needing urgent outside cash.
Okay, finally, let's touch on competition. Specifically, you hear a lot about increased activity from Chinese marketplaces across Europe. Management sounded pretty confident they can handle it. Why?
Well, they argue the direct competition is somewhat limited because of structural differences. They say the Chinese players typically focus on the most price-sensitive shoppers, often with cross-border, lower-value items. Allegro, on the other hand, positions itself with a wide selection of branded products, high trust, and better service, like through their smart loyalty program, which, by the way, now has over 6 million subscribers just in Poland. They're playing more of a quality and service game, not just a race-to-the-bottom price game.
And they're not just competing on the platform, they're actively lobbying regulators too.
Yes, that came up. Management confirmed they're working with other European e-commerce players to advocate for, quote, fair competition and equal rules. They hinted that some foreign players benefit from what they see as an unfair advantage in Europe, likely related to things like VAT or customs rules, and they believe that needs to be addressed to level the playing field.
Okay. Before we jump into our trade idea segment, just the usual quick but important reminder for you listening. We're presenting analysis based on the earnings call materials. This discussion is purely for informational purposes. Please always do your own research.
Absolutely. Okay, thesis time. Here's the outrageous but plausible trade idea based on these Q2 dynamics.
All right, lay the conviction on us. What's the thinking?
Okay, the core thesis is this. Allegro is clearly, demonstrably executing a pretty deep self-help program, particularly in logistics and monetization. That rising Allegro managed volume figure, now at 34%, is fundamentally decreasing how much they have to rely on third-party delivery pricing, like from InPost. We think the market is currently over-discounting this operational success because of that InPost arbitration risk. But we believe Allegro is actively mitigating that risk with its own strategy.
So if Allegro is taking more control of its own delivery destiny, who loses out?
So the trade idea is go long Allegro, betting on their continued Polish dominance and margin defense, while simultaneously shorting a pure-play Polish logistics or delivery competitor. The rationale. Allegro's increasing managed volume, combined with network diversification through DPD and the accelerated build-out of their own lockers. It fundamentally shifts the power dynamic in delivery pricing negotiations. This transition directly pressures the margins of its former biggest partners and, frankly, other legacy logistics players in Poland. It's basically a bet on Allegro's infrastructure build succeeding, partly at the expense of their supply chain partners' profitability.
That's a compelling bet. A bet on power consolidation through self-sufficiency and strategic investment.
That really is the core takeaway here, I think. Allegro showed robust execution, really aggressive logistics investment, clear strategic direction. Yet the market is basically demanding concrete clarity on that legal and cost overhang before it'll fully reward the results. The company is actively building its own moat, against both competition and external cost inflation.
And that leads us nicely to our final provocative thought for you to mull over. Given that management is explicitly exploring externalizing their logistics and fintech solutions, is Allegro actually evolving? Are they moving from being just a pure marketplace into becoming a more diversified tech and logistics infrastructure provider? And if they successfully monetize these internal tools, how fundamentally should the market adjust its valuation multiples for this business?
It's a potentially massive strategic shift, yeah. Definitely something worth watching closely. Thank you for joining us for this deep dive into the Allegro Group Q2 2025 earnings call.
We'll catch you on the next one.